Diversification comes in various ways, and we briefly talked about this in the prior videos when we talked about allocations of portfolios. Today, we are going to go into more depth about how to actually diversify. And since this series is about investment in stocks, we'll focus primarily on stocks. With any kind of risk mitigation, you need to consider your timeline. For example, how far away do you think realistically you will achieve your financial goals? Do you think you actually may need some of your investment money in the near future? And do you have a lot of financial debt? There are three main ways to diversify the stocks, and we'll discuss each one of them in more detail. Number one is the company size, whether if it's a small, medium, large cap. And we'll talk about what this means. And second one is growth versus income stocks. And the third one is through the industries and sector. So let's first talk about the company size. What is the company size? And how is it being determined? Usually in the stock market, when we're talking about a company size, whether if it's a small cap, big cap, mid cap, the cap stands for market capitalization. And it is actually a very simple calculation, which is done through the stock price times the number of shares. So let's say if this company sells its shares at $10 per share and they have, let's say, 10,000 shares, then their total market capitalization is $100,000. So for a large cap company, they are usually considered to be a large cap if they have more than $10 billion. And mid cap is $2 to $10 billion, and small cap is less than $2 billion. This is just a general rule of thumb though. So when you are looking at investment and diversification specifically, why does this market cap, why is this important? Well, let's take an example, right? Let's say if you're investing into a company that's a large cap, for them to grow 10%, let's say if they have $10 billion in their market capitalization. If they grow 10%, that means they have to gain $1 billion in terms of their capitalization. Versus if they're a small cap with only maybe $1 billion in terms of total capitalization, then in that case, they may only need to gain $100 million. And that's a significant difference, right? So hence, small caps have more potential for higher return. It is easier for them to increase by 10% versus a company that's much bigger. Moreover though, small caps are more volatile, so it is important to consider the risk versus reward. Large caps are more stable, but they're less likely to grow as fast. But small caps, they have more inherent risk because they are smaller. We also talk about growth stocks and income stocks in terms of diversification. So what is a growth stock? You probably have heard of this quite a lot. And just like the name suggests, it is a stock climber where the expected stock price will actually grow a lot from year to year. It is usually faster than the industry and the market. And this means that usually from a financial standpoint, they are growing in revenue and they have a good cash flow. They usually have a higher price to earnings ratio and a higher to price to sales. So what does price to earnings ratio essentially means is that the stock price may be much higher than their actual revenue for the year. Typically, these growth stocks do not provide dividends as the company would rather reinvest the money for further development. And a good example is Tesla and Google. They're both considered growth stocks at this point. And we also talk about income stocks. So income stock is basically on the other side of the spectrum compared to growth stocks. They do pay a dividend to stock owners on a quarterly basis, hence the name income. And an example would be Coca-Cola. Annually, Coca-Cola actually pays their shareholders 3% of interest, meaning that if you hold at least one share of Coca-Cola, each year you'll be getting basically 3% of your total share amount. And that's actually pretty decent. There is a slight difference between income stock and value stock, and I want to highlight over here. Most of the time you think that it's the same and you hear it to be the same. But actually, value stocks' true definition is stocks that are really undervalued, meaning that the stock price to revenue ratio is lower than expected. And this may sound like a bargain, right? Because you're basically paying less for what maybe the company is potentially worth more. And that is true. However, there could be cases where value stocks are companies that's actually not doing so well. And maybe they never will recover. In that case, they do possess a really high risk. Versus income stocks are usually large companies such as, for example, Johnson & Johnson and Coca-Cola, like we mentioned. And they don't really have much risk, even though they do pay their shareholders a dividend. So it is important to kind of understand the difference between income stocks and value stocks. So in this case, you may want to also diversify your portfolio between a growth stock versus a income stock. Perhaps maybe you have too much in the growth sector. So in that case, maybe you want to diversify a little bit more into income stocks because they do pay a pretty significant amount in terms of dividend, which could lower your risk during the downfalls of the stock market, like right now. Lastly, we talked about the industry and sector as another potential factor in terms of diversification. So what does industry and sector means is really just the name suggests what sector or which part of the economy does the company belong to. For example, of course, we know about technology companies, we know about healthcare, we know about maybe energy sectors. These are different industries. And within these industries, there may be subsectors. One example is maybe in the healthcare, there could be pharmaceuticals, there could be maybe just healthcare related, specifically medical device related type of companies. And lastly, of course, there could be like biotechnologies, ones that's maybe just researching about a new type of drug development. And each one of them are slightly different from each other, even though they may all belong into one giant bucket of healthcare, right? So why do you want to know what industry? The reason, of course, is if you diversify, you may look into different industries. If you only have been investing in technology sector, then perhaps it's a good idea to look into other sectors as well. Because different sectors are different in many different ways. For example, their operation, their cost, and their revenue model may all come in different ways. So if you compare a technology company to a healthcare company, they're absolutely different, and the way that they generate revenue could be completely different too. So it's not really fair to compare these stocks that belong to different industries. And if you want to compare, it's usually within one specific sector. It is also important to note that stocks within the same sector tend to move in unison. For example, the utility sector may go up and down in unison compared to healthcare companies. And that's just the nature of things. That's why if you diversify and move into different industries, then you could lower your risk of volatility. If one of your sector that you have invested in is going down, at least maybe another sector will be behaving differently. However, nowadays it is very common where the stocks are all moving in unison, such as the S&P 500, which is actually investing in multiple different subsectors as well. But it is still important nowadays to look at the industry. So to recap, we talked about the three different ways of diversifying the stock market through the company size, growth and income stocks, as well as lastly the industry and sector. I hope through these categories you have gained some insight on how to diversify, and perhaps you'll realize that all your stocks might be in, for example, big cap companies, so maybe you're missing on some potential growth in small caps. Or maybe all your stocks are in technology, so you think that you should go into more healthcare. If you enjoyed this video, please again to remember like and subscribe to the channel. This helps me tremendously. Thank you so much.